Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include home price growth across different metros, my interview with LoanLogics' Roby Robertson on the proliferation of the non-QM mortgage market, and why there's no shortage of news shaping investor sentiment. Today's podcast is presented by Fly Homes, the leading wholesale lender focused on exclusively buy before you sell solutions. They empower loan officers and agents across the country to help their home buyers purchase their next home before selling their current one, eliminating the hurdle of sales contingencies, double moves, and financial roadblocks. Whether your borrowers run into DTI issues, need to unlock home equity for down payment, make a stronger cash-like offer, or even move potentially with no cash out of pocket, Fly Homes provides a full suite of financial products to help them move forward confidently before selling their current home. You know why Ireland is so expensive? Because house prices are always doubling. It's that kind of cutting-edge humor that brings you back day after day, I know. Those days are temporarily over in the United States, and the pendulum is quickly swinging to more inventory and price cuts in many places and price points. Of all the major metro markets, Phoenix boasted the greatest number of listings with price cuts, at 31.3%, up more than 7 percentage points from the same period last year amid rising inventory. The typical home in Phoenix costs $525,000, representing a drop of more than 3% from May of 2024. Here in Tampa, where I currently am, Citizens saw the second biggest share of discounted listings at just below 30%. The median list price in the Sunshine State market stood at $417,500, having shed 1.6% compared with the same time last year. Coming in at number 3, Denver had 29.4% of local home sellers slash prices on their properties last month. Let's dive into a little more data here. And it's true that last week's data painted a mixed picture of the job market amid the uncertainties of the Trump administration's tariff wars. ADP private sector payrolls slowed down, job openings unexpectedly rose in April, and non-farm payroll was somewhat weak. There's nothing to change the status quo for the Fed. Some economists are revising forecasts for any activity from the Federal Reserve's Open Market Committee and expect a rate cut in September versus July previously, and at each of the subsequent 4 meetings through March. But the most common forecast among major Wall Street banks is for just one cut this year, either in September or December. And there's certainly no shortage of news shaping investor sentiment. In the U.S., the National Guard has been deployed in Los Angeles. In London, trade discussions between the U.S. and China are underway. In the East Mediterranean, Israeli forces intercepted a ship carrying aid bound for Gaza. In January, President Trump returned to the White House with significant foreign policy goals, including ambitions to broker a peace deal in Ukraine within 24 hours, facilitate an agreement between Israel and Hamas, and reset global trade dynamics in favor of the U.S. However, these outcomes have yet to materialize. Despite early assertions of rapid progress, major foreign policy milestones remain unmet. And no, that isn't a political statement. So far, the administration's most tangible trade development is a limited short-term agreement with the United Kingdom. Nuclear talks with Iran have been described as promising, but no formal nuclear agreement has been reached. While it is still early in the term, the ambitious pace and scope of these objectives appear to have potentially underestimated the complexities of global diplomacy and the extent of U.S. leverage in these negotiations. For today's interview, I want to welcome to the show LoanLogics' Roby Robertson to talk about the proliferation of the non-QM mortgage market, examining its key growth drivers, borrower trends, technological advancements, and how lenders are navigating risk and compliance amid shifting economic conditions. Prior to joining LoanLogics in 2021, he served as VP of Product and Marketing at LoanBeam, and he has more than 15 years of experience in financial services, holding various leadership positions with Fortune 100 companies and multi-million-dollar startups.
So I think it would be almost an understatement for me to say that the non-QM market has seen renewed interest in recent years. This has been a huge topic lately, the proliferation of non-QM, both because it just makes sense for modern times, but also because Fannie and Freddie's underwriting guidelines leave people in a strict box. And at one point, they were meant to promote liquidity in the mortgage market, but it seems like we've almost evolved past the need for Fannie and Freddie's strict credit box for liquidity. And take that with a grain of salt. Fannie and Freddie are still vitally important players. But when you look at non-QM growth that we've seen, it went from being this, non-QM, it's not subprime. It's way past that PR crisis, if you will. It's its own thing. It's grown up. People love it. Borrowers love it. What do you view as the biggest drivers behind the growth?
I mean, I think it's kind of a, story as old as time, really. I mean, really what you have was, when rates were strong and great, rates were very, very low, and you could you could find a really strong market with high profit margins, and you could just close deals on volume, right? I mean, lenders were just doing a lot of deals, so margins were tight, but that's okay because it's a volume business, and you could always find somebody that had great credit to get a really good rate. As rates tightened, I think lenders started to push the edge of that credit box. So I think we saw the uptick of non-QM even creeping into 2022, but what you saw was non-QM deals that kind of fell out of the traditional credit box. So what you saw as behavior is we're still trying to get the traditional deal. We're still trying to get the conventional deal, but we're having to kind of go to the edges of the credit box, and deals are falling out. And so it's worse credit scores, maybe DTI is high, so they're falling out of the requirements of a conventional deal. They're going in non-QM, but what we saw in 2023 is we're seeing some 30-day lates, and we saw some kind of bad paper showing up. Now, what that caused the lenders to go, all right, we need to get creative. We need to go where the market lives, and we need to do non-QM, but we need to do it in the right way. And so there's plenty of great credit individuals make a lot of money, but they may make it in non-traditional ways, right? And so you have to find it and quantify it and validate it in different ways. So you have to get a little bit more creative in it, and you have to put a little bit of elbow grease in to get the deal done. But you have great margins, and you have strong portfolios that do perform well. And so I think what you see non-QM continuing to climb because you don't have the volume business that you had when rates were really, really tight. I mean, really, really strong. And so you have to make profits the other way, and that is to do better deals that earn really good profit margins, because there's borrowers out there who do want the money, but they just need a kind of non-conventional terms in order to get that deal done. And so I think what you're saying is, to your point, Robbie, you said, this is kind of the world we live in now. Self-employment is on the rise. People are making money outside of traditional employments more and more often. And I think you don't have a lot of borrowers who are just fitting in the box and that want to get rid of their 3% mortgage, right? So you have to really look at who can we lend to that makes sense, and just, do a little bit of extra work with that.
Yes, there's certainly demand out there, not only from borrowers for this product, but also from investors. Although I do want to ask you about the sustainability of the space. And I don't mean that in the sense of will it keep growing or is it here to stay? I mean it more so in the sense of, and obviously this is 5 years ago at this point, but liquidity dried up during the pandemic, or at least at the start of the pandemic, in the non-QM space almost overnight. And you're a champion of the non-QM space. So you're going to say that's obviously not the case anymore. But when it comes to potential pitfalls like that, when I ask about sustainability, how do you view kind of clouds on the horizon out there, if there's any storms to be weathered, if you will?
I think as your rates stay consistent and stay high, again, lenders need to be able to make the margins or make the profit that they need to make, and so they're going to design products that make sense, that are safe, that have good quality borrowers, but they're just going into territories that they wouldn't normally do, and that's because, again, the straight ahead deal, it's tough to find somebody who wants to refinance their 3% mortgage. As we see changes at the top, right? And we see, maybe Freddie and Fannie start to kind of move back into privatization. I think what we're going to see is the FHFA kind of, moving away, but they're going to start requiring more things from them. They're going to require, greater guarantees. I think we're going to still see kind of a stiffening in the liquidity for those traditional deals. But I do think there's a huge investor market out there that is looking to make money on mortgages. It's still a very safe play. And so I think there's going to be a lot of private money in the space that is going to look for opportunities to make money on, quote unquote, non-traditional, non-qualified deals. So I do think we've opened Pandora's box, and what we've forced the industry to do is look elsewhere for money, and that money is interested in investing in something that's gonna pay good rates and pay for a period of time. I think we've seen a paradox shift where people have both learned that we can do non-QM and we can do it safely. We just have to change the way we kind of handle validation of certain items. And I do think it's here to stay. If we see another 3% era where rates are so strong that you can kind of just go through your entire portfolio and return it, well, then you might see kind of a push back to traditional deals. But I think that's a long time from now.
Yeah, very good point there. Non-QM's come a long way. And when people say non-QM, it's not like it's just one product or program necessarily. There's a ton of products within non-QM that serve a variety of borrowers. Can you elaborate a little bit on the various borrower segments that are most actively served by non-QM products today, and kind of how the borrower profile has evolved over the years?
When you think of non-QM at the end of 2022, it was non-QM was, were deals that just fell just outside the box. They were on the margin and they went the wrong way. And so, it was, high DTI, maybe low credit scores. And so they kind of fell outside the scope of, Fannie and Freddie deals. And so that's obviously very different, though, than the non-QM that we see creeping up, right? Some of our largest clients, some of the biggest aggregators in the space, they're getting into non-QM in earnest. And they're doing it the correct way. And the correct way is there are still great borrowers out there that have great credit, that have great income, great assets. They tick all the boxes. The only thing that they don't tick is, qualifying their income through traditional means is something that is possible for them. So maybe they own, 200 rental properties, and their income comes into those rental properties. And so, peeling apart, what their income is from those rental properties is a little tougher than normal. Maybe they're self-employed, maybe they're an influencer, maybe a ton of their money comes in through, just getting money in through YouTube, and it's landing in their bank accounts. And so how do you validate that money coming into bank accounts? So lenders are targeting great candidates, but just you need to do a little bit non-traditional means in order to go after them. So, obviously, when you look at that kind of borrower segment, Robbie, it's probably, they definitely lean self-employed. They lean, and if they're not self-employed in quotes, they're definitely folks that make the assets or have the assets to be able to be credit worthy. But again, it's just how do you validate that income? So it's wealthy or affluent individuals that are making money maybe non-traditionally.
Yeah, it's a great point. People that listen to this podcast regularly have heard in some recent discussions I've had complain about how the industry is great at finding debt obligations, but not necessarily as good at finding ways to count or qualify all the income that people make. And so it's cool to see that these non-QM products are innovative and serving a lot of people. There's a huge technology play going on right now in the industry. Obviously, AI has been a huge buzzword, but just in general, the loan process, the borrower experience, the efficiencies that are there to be gained, the potential cost savings on closed files. How are non-QM lenders leveraging technology? There's you mitigate risk, you can ensure compliance, whether it's an origination or servicing. You talk about kind of how the tech in the non-QM space has evolved.
I'd like to say that lenders consistently are leveraging technology well. I think what we saw some data coming out of Freddie, I think it was end of last year, where the cost of loans has skyrocketed, and a big part of that, Robbie, is it's the cost disease. It's like we introduce technologies that are supposed to help us, and we don't really reduce the overhead that it was supposed to reduce. And I think that's what we see a lot is lenders will kind of toss technology at things. But they don't really solve the overhead problem that they had anyway. What I'm seeing, as you've probably seen in the past, is with non-QM, you throw bodies at it. You need to go after, more experienced underwriters or specialty underwriters who understand how to do that, so that, they have long tenure and, a lot of experience, and obviously they're costly. I think we do have some of our largest aggregators that are leveraging our technologies to do automation the right way. And what do I mean by that? I mean, they're using technology to really do the legwork for the team and let the team focus on just the last 10%. That's the risk assessment. They're feeding it into systems to truly drag out the important data out of the file, organize that data, put that data together in a very seamless story that then the underwriters of the teams can look at and say, all right, we're now just going to focus on assessing risk rather than going through all the data, extracting all the data, entering all the data, and doing all that. So I think the best lenders out there, I think Freddie's data showed this as well, that lenders that are truly automating their process, we're saving, I don't know, something like $1,400 a file and knocking off 7 days out of the process. I think that's exacerbated by non-QM. Non-QM takes more sophistication, more thoughtfulness, more investigation of like non-traditional documentation. And so if you don't automate, you're not using technologies, such as LoanLogics technologies, you're not going to be able to focus on risk assessment. By the time your team gets to the end, they're fatigued. They've done too much to try to prepare that file. And at the end, they're just like, I really just want the file off my desk.
You have a lot of insight into the market because LoanLogics supports a large share of the market. Are there trends you're seeing in loan quality, or documentation challenges, or investor appetite specifically for non-QM loans? And I say that in comparison to agency loans out there.
1 in 2 deals that go through the country, go through a LoanLogics tech. And so, we acquired LoanBeam end of 22. And, LoanBeam is known for its income calculation and it lives in the origination space. And then LoanLogics has traditionally been an audit technology that is that's reviewing every deal that pops out the backside, non-QM or not. And so I think we have recently pulled some data in our set that shows we kind of went 10 years back, 5 years back, 2 years back, 1 year back, and we pulled some data. And we found that the file issues, both from a data issue, which is to say that the data that was claimed in the file was not supported by documentation. So the data was wrong. So the source of truth on that file was wrong. We also compared all the information, all the docs as well, to say, are the docs consistent? Are they accurate? And we saw consistently across the kind of 10 years of our data, really nothing has changed. Lenders we're still seeing 5 to 10% error rates across those sets. Now, the anomaly was, though, Josh, was 2019. We saw a spike in docs and data issues, and we could speculate, but it's probably twofold. One is when you're really, really busy, you make mistakes, right? And when you're really, really busy, you hire people off the street, and you never know the quality of that person, right? And so you just, like anything, you're limited on inventory. So if you're in a town that has 2 other lenders in that same town, it's tough to get good people off the street. And so we did see an uptick. I think it was almost double the error rates in the data in 2019. That's obviously a direct reflection of high volumes and inexperienced staff. So if a lender, I think the moral of the story is, if a lender doesn't solve their data problems with automation and with technology, then when the volume does come back, which it will, when the volume does come back in earnest, then you're going to see the same kind of data integrity problems that pop out the other side. So that's what we're seeing in our data, and I think we're in a unique position because we do audit files across the top aggregators in the space, And it really doesn't matter whether it's, non-QM or traditional, we audit across all of them.
It's a volatile time in the market. And as I alluded with the agency loans, it seems like there's tightening credit standards out there. How do you see the role of non-QM shifting in the broader mortgage ecosystem over the next 12 to 24 months? Something tells me you're going to say it's going to continue to keep growing here.
I do think so. And I think you've seen some of the consolidation of some of the biggest players in the space, right? So you've seen, the UWM kind of take control of its pipeline, take control of its space. You've seen Rocket kind of taking control now of the borrower segment that they want, and now with the acquisition of Mr. Cooper, they're even controlling the servicing. So, and then standing next to them, like a behemoth is ICE. And so you see some of these biggest players in the space, and they're trying to go end to end. And now with Fannie and Freddie, potentially coming back private, what you have then is Fannie and Freddie kind of having to stand in line and compete with some other, very big organizations that have access to investor dollars at the top. And so you're really going to see, I think you're going to start to see more and more creative lending opportunities across the entire ecosystem. And you're going to start to see investors who find value in certain segments of the borrower population, and they're going to be willing to put their dollars down to securitize it. And so you're going to start to see lenders focus in on certain areas of the public. As an example, I have a client and friend that they spearheaded a lending company that is focused on lending to customers interested in buying their manufactured home. So they were in that business. They had properties, and they were leasing out manufactured homes. And then they realized that there is a really strong market in lending to manufactured homes. And there's lenders out there who are willing to lend on that. They have experience with it. They know it. But it is a niche segment. But believe it or not, one of their biggest competitors is Berkshire Hathaway. Doesn't get bigger than Berkshire Hathaway, right? So that's a good example of a non-traditional deal, non-QM deal that is going after a specific market segment. And there is investors that see that as a very valuable investment, and the dollars will follow. So I do see that non-QM is going to continue to climb. I see the market is going to get more and more creative in their product offerings and serving more and more of the borrower population, and being able to get borrowers in homes for the first time when in past they didn't. And that's really just going to continue to thrive until we see a market that's 3% rates, and then everyone's just going, just churning their book of business.
Well, I don't know if we're going to see 3% rates again anytime soon. So that certainly bodes well out there for non-QM. I really appreciate you coming on, Robbie. Always nice to talk to a fellow Robbie first off, but also non-QM, as I said to you offline, it is becoming such a core part of the industry. And it's great to get the word out about what's going on from an insider perspective. So thank you very much for your time.
Yeah, thank you, Robbie. It was a lot of fun.
Trade negotiations between the U.S. and China remain the primary focus for financial markets, particularly around issues like rare earth materials, which are important to the U.S., and technology, which is important to China. Trade talks in London between China and the U.S. run through Friday. The U.S. wants to see an end to export controls for rare earth elements, while China wants access to jet engines and technology. Any signs of progress would generally benefit risk assets, but the implications for treasury yields are slightly more complex, as a return to the traditional risk-on, risk-off behavior may cap any potential downward movement in rates. A de-escalation in tensions, however, would likely support treasury prices and thus reduce yields by reducing the urgency to reallocate capital away from U.S. assets. Upcoming 10 and 30-year treasury auctions will offer a timely gauge of demand amid trade uncertainty, even as this trade-related volatility overshadows the underlying economic fundamentals. Recent economic data continues to point to a resilient U.S. labor market, but signs of potential weakness are emerging beneath the surface. Although May's payrolls came in slightly above expectations, downward revisions to prior months and a notable uptick in jobless claims suggest the labor strength may not be as durable as it appears. Markets will pay close attention to upcoming claims data for further clues, especially as the economic impact of the ongoing trade war remains difficult to quantify. The delayed effect of tariffs means that inflationary pressures may be pushed into the second half of the year, creating additional uncertainty about whether continued trade tensions could eventually stall employment gains and broader growth. At the same time, inflation remains the central economic narrative domestically this week, with CPI and PPI reports expected to show further modest increases in core prices. These developments suggest that businesses may be gradually passing higher costs on to consumers, although recent consumer surveys show inflation expectations trending slightly lower. The combination of easing inflation sentiment, lower energy costs, and temporary tariff relief has helped boost treasury markets, particularly shorter-dated bonds, while longer maturities recovered yesterday after early declines. With no breakthrough yet in trade talks, markets remain highly sensitive to headlines and policy developments, likely holding out for more concrete direction in both monetary policy and the global economic landscape. The NFIB Small Business Optimism Index for May led off today's economic calendar, slightly improving. Later today brings Redbook same-store sales, Treasury activity that will be headlined by an auction of $58 billion of 3-year notes, and the New York Fed conducting a buyback in treasuries for cash management purposes for up to $10 billion. Fannie Mae reported that despite higher mortgage rates, home purchase sentiment jumped in May to its highest level since November. We began June 10th, which is my dad's birthday, go wish him a happy birthday, with agency MBS prices a few ticks or 30 seconds better than Monday's close, the 2-year yielding 3.98, and the 10-year yielding 4.44 after closing yesterday at 4.48%. Let's wrap up with a joke and some housekeeping. Following the advice of his doctor, Mr. Johnson moved to Florida. When he arrived in his new Florida home, he met his next-door neighbor. And the neighbor was a man around his age, but he had a full head of hair and appeared to be very strong. "Hello," Mr. Johnson said to his new neighbor. "Is Florida as healthy as my doctor says it is?" "Let me tell you something," said the neighbor. "When I first arrived here, I was completely bald and I was so weak I had to be lifted out of bed. I could barely even move across my own bedroom. And look at me now." "Amazing," said Mr. Johnson. "How long have you lived here?" "Oh, I was born here." Thanks again to Fly Homes, the leading wholesale lender for buy-before-you-sell solutions. Whether your borrowers run into DTI issues, need to unlock home equity for down payment, make a stronger cash-like offer, or even move potentially with no cash out of pocket, Fly Homes provides a full suite of financial products to help them move forward before selling their current home.